Demystifying non-resident rental income tax rules in Canada. Explore the tax requirements for non-residents earning rental income in Canada. Discover crucial details on Section 216's tax provisions and implications. Non-resident rental income tax requirements for Canada. Canada is known for its diverse real estate market, attracting investors from all around the world. For non-residents who own rental properties in Canada, understanding the tax implications is crucial. In this article, we will delve into the intricacies of non-resident rental income tax requirements in Canada, particularly focusing on Section 216 tax provisions. Non-resident rental income in Canada. Non-residents of Canada who earn rental income from properties located in the country are subject to certain tax obligations. The Canadian tax system requires non-residents to pay tax on their rental income derived from Canadian properties. This includes income from real estate rentals, such as residential homes, apartments, commercial properties, and vacation rentals. Section 216 Tax. One of the significant provisions that non-resident property owners need to be aware of is Section 216 of the Canadian Income Tax Act. This section outlines the rules and requirements for non-residents who earn rental income from Canadian properties. Under Section 216, non-residents must file a Canadian tax return to report their rental income and pay taxes on any net rental income earned in Canada. Reporting rental income. Non-resident property owners are required to report their rental income earned in Canada to the Canada Revenue Agency, CRA. The income must be reported in Canadian dollars, and expenses related to the rental property can be deducted to determine the net rental income. It is essential to keep detailed records of all income and expenses related to the property to accurately report the rental income. Reporting rental income. Non-resident property owners are required to report their rental income earned in Canada to the Canada Revenue Agency, CRA. The income must be reported in Canadian dollars, and expenses related to the rental property can be deducted to determine the net rental income. It is essential to keep detailed records of all income and expenses related to the property to accurately report the rental income. Compliance requirements. In addition to reporting rental income and paying taxes, non-resident property owners in Canada must comply with other tax requirements. This includes obtaining a Canadian tax identification number, filing a Canadian tax return, and fulfilling any withholding tax obligations. Failure to comply with these requirements may result in penalties or fines imposed by the CRA. Impact of tax treaties. For non-residents who are residents of countries with which Canada has a tax treaty, the provisions of the treaty may impact their tax obligations. Tax treaties often contain provisions relating to the taxation of rental income earned in a foreign country, including rules for determining taxable income, tax rates, and tax credits. Non-residents should review the specific provisions of the tax treaty between their home country and Canada to understand how it may affect their tax liability. Conclusion. Non-resident rental income tax requirements in Canada can be complex and may vary depending on individual circumstances. Understanding the implications of Section 216 tax provisions, reporting rental income accurately, and complying with tax obligations are essential for non-resident property owners. Seeking advice from a tax professional or accountant with expertise in international tax matters can help navigate the intricacies of Canadian tax requirements for non-resident rental income. Need help filing under Section 216? Call 416-283-8774 or visit theaccountingandtax.com.